Good evening, everybody. Thanks very much for joining us. It's much appreciated to see you again. This week, I want to talk about commodities in general and the current backdrop that we've got for, in particular, gold, oil, and natural gas during October, and actually what the charts are beginning to highlight and beginning to show are the developing risks and potential after what has obviously been some pretty volatile times for markets. So we're going to start and look at oil. And I think with all of these three commodities that we're looking at tonight, we really have to start by looking at the longer term pictures to put recent moves into some sort of context and to highlight how that's likely to develop and materialize over the course of coming weeks and for the rest of October. And looking at the weekly chart of oil, we can see that obviously from the May lows, we've had a very significant recovery in the price of oil. We broke above the previous failure highs, and as you know, within technical analysis, if we start to see previous failure points give way, then the risk is that that can develop into a more sustained move to the upside if we're breaking in, as in this case, the previous highs. So we've seen a strong rally developing. Now, the upside into the September highs saw us challenge the November 22 high at 93.72. But if we also put on the Fibonacci retracements of the June 22 to May 23 decline, then we can see that the market actually had more significant resistance to deal with around the 93.96 midpoint of that sell-off. So that combined with the previous highs, and we did trade up to 95 the figure, but then rejected fairly significantly and fairly quickly from that area. And basically the market is still highlighting the potential of a more extended consolidation correction phase materializing. Now, obviously, we've seen some quite volatile activity beginning the week, and that's seen as rally fairly strongly from the previous week's lows. But the concern from a technical viewpoint is that we've already seen a weekly close below this 83.18 area, the 38% retracement of that latest recovery, this year's rally. And that highlights deterioration. So while the market has rallied from last week's lows, is there really anything within this activity to suggest that we're ending this corrective phase, or we can see further upside beginning to materialize over the next few weeks into the end of the month? Well, for me, on the weekly chart, the first important resistance area is the midpoint of this latest sell-off, which comes in at 88.35. So that's an area, that's a point that I would be focusing on within the weekly picture. And while we're below that area, the risk is that we're still looking at limited upside as just a reaction to the latest declines, because this failure also developed into indecision. We saw what's called a doji pattern. So the market tested upper resistance points, rejected, and we opened and closed the week at the same area. That indecision then turned to more negative themes as the market sold off aggressively and closed below this midpoint. And the current rally really has to break this 88.35 region to trigger a more sustained upside move. Now, when we put this into the daily picture, we can see that, yes, the rally has been quite a significant bounce after the latest declines. But again, it's that close below this 38% retracement level that highlights technical deterioration and the risk of increased selling pressure beginning to materialize. We also look at the latest rallies this week, having opened on a gap higher this week on Monday's opening price. We're so far being held by the 38% retracement of this sell-off. So we're basically looking at 86.77 as being the immediate resistance focus for oil. And if this is to develop into a more sustained upside move, then I think it's this point that we would have to break. But while we're below it, the potential is we can see further pressure build, and that can extend this correction phase back down towards the recent lows, towards the midpoint at 79.49. And if that starts to give way, potentially even further. So we know the levels that we need to watch. To the upside, the immediate point, 86.77, then the 88.31 midpoint, and which will then link with the declining Bollinger mid average. So it's this area, this range, that's going to be very important towards price action. But while we're below it, the corrective risks within oil are still a possibility. Okay, so that's oil. Let's look at gold now from the same sort of perspective, looking at the weekly and the daily charts. Now, with gold, from a technical viewpoint, the significant development has been, again, the failure above 2000. So in other words, on a weekly basis, back in August 20, March 22, and in May this year, we attempted to break above the 2000 level. But look what happened each time we tried to do that. We saw clear rejections, significant selling pressure developing. So the lengthening upper shadow that we can see on each of these weekly candles reflects the strength of selling pressure. And the fact is that we've failed and seen a significant sell-off developing from this type of resistance. So that confirms the long-term supply, the resistance area at higher levels. But what's happened subsequently within this sell-off is that we've broken below the midpoint, or the first negative signal was the break and close below the Bollinger mid average. Then when we tried to bounce, we failed to really close above that level. The mid average then turned down to reflect a more bearish trending condition. And each time we've attempted to rally, gold has found selling pressure from this declining mid average. Now, currently for this week, that Bollinger mid average is at 1921. So again, that's the longer term resistance focus that we need to monitor to the upside. And to be honest, while we're still below that level, the risk is that we're looking for more extended consolidation correction risks developing. So what's actually else has happened to really sort of highlight that downside potential? Well, again, even after this week's rally, we've seen closes below 1850, which was the midpoint of the September 22 to May 23 price strength from then that led into the rejection. So again, this is highlighting some sort of technical deterioration, the risk of a deeper sell-off, and we will rally within negative themes, but the evidence at this stage still points to upside being more limited within what is a developing downtrend. The mid-average is declining to reflect that bearish trend. And the risk is that, yes, we can see a further bounce, but this is still more negative conditions that can see over the slightly longer term a deeper retracement move. So then we look at the daily chart, and really what are we trying to highlight here? In that, yes, it's been a very strong bounce, but you'll notice that we're still below the declining Bollinger mid average, which is falling in a negative way. And we're also below the midpoint of this latest sell-off, which stands at 1879. That links with the declining Bollinger mid average. So for me, this 1879 level is a very significant resistance point to the current rally in gold. Yes, we can see further upside, but we would need to close above this level to suggest that the market can attempt to stage a more prolonged recovery move back towards the 1894 higher 62% retracement level. But 1879 is the critical point that we need to monitor within that type of price action. Now, if this resistance point holds, I would be watching the 1843, which is half of the latest rally. And that would be significant because if we do start to see that point give way, breaking below the midpoint of such a reactive move would suggest the potential of a deeper sell-off and those weekly structures coming back into play, and the potential for further declines beginning to develop. So again, for oil and gold, we know the important levels that we need to monitor. And yes, there have been some fairly significant recoveries and rallies developing this week, but we need to see how these resistance points are defended on a closing basis. And while we're below them, the potential is that we can see failure and a resumption of downside and a continuation of what now are longer term, more negative trending conditions. So we can rally within that type of setup, but it is still a more negative trend that's evident within both oil and gold at this stage. Okay, so let's now look at natural gas, because this technically is a very interesting picture. It's been quite boring, let's face it, for the majority of the year, and we've been in a very sort of choppy consolidation sideways activity. But finally, last week, we started to see the breakout from this range, which was quite an impressive move technically, because it's resolved this choppy sideways activity to the upside, and it's suggesting now that the directional bulls are beginning to gain the upper hand, and the potential is for a more sustained recovery into October and even in towards the end of the year. So when we start to draw retracement points on this latest downside move from the November 22 to April 23 downside, the 38% level stands at 421.5. So that is the longer term resistance focus if the market stages a more sustained upside move. However, when we start to look at the daily picture, we can see that it has been, within October so far, a very aggressive upside move. That breakout from the range, as you would anticipate, has triggered a very sharp acceleration to higher levels. Now, that has taken prices towards overextended conditions. And while sentiment is still positive, trending is still positive, the market can still move higher against overextended risks. But with that type of move, it wouldn't surprise me if we start to see, now that the Bollinger Bands are starting to highlight some sort of contraction, so in other words, a slackening of the positive volatility that's developed, that we can enter into a consolidation phase. And if we were to see that, then 322.50 is the first retracement of that latest upside move. That would be the potential support area for me that I'd be looking to potentially hold and even turn risks higher once more. And then that weekly longer term picture does highlight the potential for a higher retracement. So I think with natural gas, it does look as though we've attempted to see quite an important break to the upside from this sideways trading range. It doesn't rule out corrections and consolidations, but while we're above the 322.50 area, the potential is for that region to hold and prompt further attempts to extend what is now a more positive trending condition. So I think certainly commodities are going to be very interesting into the month end and even into the year's end. And the risks seem to be that we can see further pressure developing in oil and gold, while natural gas potentially is highlighting further attempts to extend the upside move. So thanks very much. That's me for this week, and I'll be back in about a month's time where we will look at something else within technical analysis. So thanks very much for listening.